I hope everyone is safe and comfortable under various conditions of lockdown all over the world. We've got people tuning in from about 6 or 7 different countries. My name is Mark Muller. I'm from director at Sanlam Private Wealth. I'm very pleased to welcome you this morning, and even more pleased to have my colleague and esteemed guru on all that is financial. Don't choke, Phil. Phil, interesting times. Is it the beginning of the end or the end of the beginning? Are you going to be able to guide us through that?
I'm going to go for it's the end of the beginning. Yeah, I think we've made quite a bit of progress through this crisis.
In a couple of weeks, and looking forward to being illuminated, or the issue being illuminated by you.
Sure. Well, thank you very much for having me. It's a pleasure to be here and talk to everyone. I've got a slide deck here which I can go through, which I think really summarizes what has happened and puts into context what might happen going forwards. I'm very much keen to get into questions and answers. So as we go through this presentation, there should be a little Q&A section in the bottom. Feel free to type in questions there, and then we'll get to those at the end. But I think at this point I'll kick off and share my screen and go through the slides, if that works with you, Mark.
Perfect, thank you, Phil. And then I can also I can scroll through the questions as they come through and then relay that on to you insofar as you need that.
Perfect. Okay, let's do this. Share. Perfect. Okay, hopefully everyone can see these slide deck. Okay, I've labeled this a time for patience, and I think what we've seen is an incredibly volatile market, and as we said at the beginning, you know, this is probably the end of the beginning, and we're getting into that middle stage, and this is the stage where we do need to see a bit of patience, and we'll talk about why that is as we go through. Looking at equity markets and how they've performed, I show here 2 indices, so global equities, excluding the UK, and also the UK equity market. Partly because a lot of the time I'm talking to UK investors and they're interested in the UK equity market. As probably more global investors, you're probably more interested in global markets and the US. But just focusing on global markets there, we can see that really severe drawdown, which of course is investment code for losses, from the 20th of February down to roughly the 23rd of March there, and then since then a recovery. So we went from very complacent markets with benign conditions to incredibly volatile markets in a very quick period of time. And this crisis was really unlike any other in the speed of which it came and onset. So ordinarily when an economy transitions into a recession, into a slowdown, it happens over a long period of time. So it happens over at least 6 months, often 12 months, sometimes longer. So if you think back to the housing crisis in 2008, you know, that really started back in 2007, and it was only in 2008 that it morphed into a financial crisis. What we saw here was, as soon as we witnessed the virus make landfall in Europe and developed market economies, you know, global investors sat up and took notice and very quickly priced in the likelihood of a deep recession, triggered by what's happening at the moment, all of this work from home, and really a stopping of economic activity around the globe. And you can see the effect on that. The next chart shows fixed income markets, and before I flick to it, I've deliberately got the scale exactly the same as equities, just to drive home partly the point that fixed income is less volatile than equities. So we can see here the fixed income market. The dark line represents sovereign bonds as per UK government gilts, and then the other 2 lines are various grades of credit. So the one that falls the most is that high yield credit, and you can see that sharp pullback there. And the point here I'd like to share with you is that, even high yield credit, it's not as risky as equities. Equities are the risk asset. High yield, yes, that is a very severe losses, but that represents a widening of credit spreads pretty much as far as they go, from razor thin to pretty wide recessionary type credit spreads. And so, risk control has worked for different portfolios. If you're in a risk-graded solution at the lower end with more fixed income type instruments in your portfolio, your losses will have been less and you will have been protected. And you can see the bounce back in returns as well in both those instruments. I want to talk about volatility. This is probably less critical at the moment, but when we were a couple of weeks ago, it's been a very fast moving market. A couple of weeks ago in the depths of the crisis, that volatility measure spiked. And at that time, there was a lot of fear and panic in the market. Now, this is the VIX measure of volatility. So it uses puts and calls and teases out implied volatility from prices in the market. And ordinarily, in situations of calm and normal markets, that volatility can range between 10% and 20%. But then in heightened times of uncertainty, volatility rises. So this is where you've got a pull and push on investors. They're not quite sure where things should be priced. We've got price discovery going on. There might be news that's coming in heavy and fast. You get daily swings at a plus or minus 6%, 7% in equity markets. And you see volatility rise, and it actually hit that 80 point. This is a weekly chart. If you look at it on the next slide, on a daily chart, you'll see it hits about 80. Now, just really the point here that historically, once volatility's moved above 40, most of the damage has been done to equities. Okay, you've taken the losses at that point. And if you're a buyer after volatility breaches that 40 level, historically, you've had a pretty good outcome of returns. So I just label a couple of events there. 1998, the Asian crisis, the tech bubble. There was sort of a first signal in 2001 and then a second signal in 2002. The financial crisis. And you can see that actually, if you bought the S&P 500 and held that for 1 year, so just closed your eyes and rode out whatever came your way, those are the returns you would have got in US dollars. And you can see, 41% positive return for the Asian crisis. Initially, the first signal in the tech bubble, 11% loss. They're actually quite a good range of outcomes. Generally, they're positive. And when you do lose money, it tends to be quite small. So after that first initial bout of the crisis, the market prices in very quickly the risks that are there. And that's what we saw happen in February, so that sharp drawdown. So 28th of February was when that signal first breached that 40 level. Looking at this chart on a daily basis, you can see, from that 20th of February when the virus first made landfall in Italy and it was confirmed to be spreading in the country, volatility rose and rose and rose, and it hit that 80 points, an extreme level. And on about the 16th of March, the market started to make a little bottoming pattern. It found some valuation support. It had fallen and priced in a lot of these risks. It didn't start to rise until about the 23rd, but you saw volatility start to calm down, and you've seen it calm down since back to that 40 level. Now, it's still elevated. We still have markets that are pretty fast moving. If you look at futures today, they're up 3%. And they're up 3% on the fact that Donald Trump is talking about reopening the economy, and also some positive potential news from Gilead, a company in the US that may have found an effective treatment which reduces the number of deaths that we might have and also speeds up the recovery. So, a couple of positive data points today, and the market's up 3% on the back of that. So we still have volatile markets, but we're finding a way out of this solution. And for me, we're in the middle stage of this crisis now. We've had the initial pricing of risk, the fall in markets, the pricing in a recession into the bond markets, and now we're through to when are we going to get out of this, and when can we get back to growing earnings and companies getting back onto a normal footing. This is the bond market, and really that the bond market, I would say, was front and center in what has been happening recently. Now, this shows credit spreads. So credit spread is the extra return, so the extra yield to maturity that you get for taking on credit risk. And there's three different grades of credit here. There's A grade, which is investment grade, but very strong investment grade. There's triple B, so that's at the edge of that investment grade boundary. So any downgrade from there would move you into high yield. Of course, there's a lot of talk about the amount of issuance that there's been in that triple B and the potential for those companies to get downgraded if their situation deteriorates. And then there's high yield, and high yield really at the eye of the storm there. You can see credit spreads, that extra yield you get for taking on credit risk, spiked to 12%. So 12% per year extra return for taking on that credit risk. Now, just to put that into context, when you get a recession, what tends to happen is roughly about 10% of bonds default. So on those bonds, those companies can't afford to pay their creditors back, so they stop payments, and then the assets are seized, and then they're sold off. So there is a recovery. So about a third to half of what you've lent is recovered by seizing the asset and selling it, but 10% of the loans you've made default. So a 12% level really does start to compensate you for what will happen in a recession. Even though there are defaults, even though there are people who can't pay and companies that go bankrupt, buying when yields are, credit spreads are 12%, tends to compensate you for that. So hence my comment here that bond markets were priced for a recession, and you've seen them improve in recent days. And of course, the big reason that you've seen credit spreads start to decline, so remember, when yield falls, price rises. So the price of these bonds is rising at the moment. That's because the Federal Reserve has started to step in as actually buying high yield bonds. So they're buying government bonds in spades. They've been buying corporate bonds, and a couple of days ago they announced they're going to buy ETFs, so exchange traded funds that purchase high yield debt. So the Fed, the Federal Reserve in the US, the central bank, is effectively buying high yield bonds in the market. And really that puts a bit of a floor under the bond market. And it means that for all of the investors in credit, because there's this buyer there, yes, you're going to have some defaults, but your price risk is mitigated. So we shouldn't really expect credit to get much worse from here. We should expect it to improve, if anything. It's priced for recession, and there's a big buyer out there. During this process, when the credit spreads widened, the bond market really closed down for a couple of days. You might have heard about bonds being illiquid. Can they trade? Really, the owners of bonds wanted to sell because they saw that a recession was coming, and they were all trying to sell into the market, but there were no buyers. So for a period of time, it was very hard to sell bonds if you wanted to trade them. And those bonds that were sold at very steep discounts in order to get someone to take the other side of the trade. What we've seen in recent times is that became a little bit more of a two-way market with buyers and sellers as the price was attracting buyers once again. And then since we've seen the Fed, it's really been a buyer's market. So for a seller's market, it's very difficult to buy bonds. Lots of people want to keep a hold of them at the moment. So conditions in the bond market very much turned positive. I just want to talk about the framework that we use when we look at equities, because I think it's important to understand how do you make decisions about when to buy equities or what value there might be there. And really, it's key to understand that investing is more than 1 year's worth of earnings. Okay, we all know that next year earnings are going to be down quite severely, but really it's about the year after and the year after. So equities are a claim on that infinite stream of earnings potential from a company, and what counts is the long run earnings power. This graph shows the MSCI World, so that's developed markets, and the earnings per share for that basket of developed market stocks. And for sure, it's cyclical, so there are good times and there are bad times. You can see from 2003 through to 2007, earnings were increasing very rapidly. They were catching up from the recession of 2000, the tech implosion. And then as the financial crisis came in 2008, those earnings fell back down again, but then we recovered and we kind of got back to trend. And I've drawn this dashed line through, which is just a simple regression that fits an exponential growth curve to this earnings number. And if the growth that comes out here is about 5.5% earnings growth. So companies will reinvest some of their profits back into their business, and they use that to grow their business, grow their earnings. and over time, that's roughly how the market earnings per share has grown. I've put some triangles on for what do we think is our best guess of what might happen. So you can see for this year, I've taken earnings down by roughly half. I've said that, okay, we're going to probably wipe out 6 months worth of earnings and then recover slightly. There'll be some sectors which are more affected, some sectors which are less affected. Utilities will be less affected than discretionary goods, so people going to hotels, for example. But as long as you assume that we will get through this, we will find some way of dealing with the virus, we will get back to work, then we can start to get back to that kind of trend level of earnings. And historically, no matter what has happened to markets, we've always recovered, and companies the index has recovered as a whole. That's not to say that every individual company survives. That's definitely not the case, but the index as a whole will. So for us, I always try and get us to focus on what's important, which is that longer term earnings potential, and really think about the valuation in that. Okay, we don't know how long this is going to take, that unknown depth and unknown duration, but I think what we do know is that we will get a recovery eventually, and we will get through this. So it's important to keep that in mind. One of the things I look at is that price to earnings power. So this takes that dashed line as the earnings base and then compares the current price to that dashed line, that earnings power, that trend earnings. And we can see that there are times when the market was ridiculously overvalued. So that the tech bubble, we all know that there are some insane valuations back in 2000, and this measure hit about 35. We also know that in 2008 on this measure, because companies were cyclically over-earning, we were juicing the economy and the returns on the financial system by that housing bubble that was going on. So the earnings was overstated there. But what you see is that when the market crashes back down and resets and hits a bottom, roughly speaking, that 15 times number has been a good base for when things have become cheap and when it's safe to go back in. I mean, in the great financial crisis, we did hit nearly 10 times. So that was a lot worse. But there we had questions over the survivability of the financial system. We had questions over the survivability of all companies. So that was a really, really extreme point. Now, what we observed recently was that number came down and it hit pretty low levels. So it hit levels of about 13. Now, what I'm trying to say here is that if the price is right, a bit like the bond market, in the equity market, you can discount some of the risks and you can start to look through them to that long-term earnings power. But there's a caveat to this. We can only look through to the long term if our investments are going to survive to the long term. And there are going to be a lot of companies out there that won't survive. So we run pretty concentrated investments at Sanlam Private Wealth. That's the way we like to do things. We like to really understand the companies that we're invested in and know why we've bought them. Everything earns its way into our portfolio. Nothing just sort of gets a free pass. We don't have any passive investments that just hang in there that we don't know about. So for us, a key point at the moment is managing this survival risk. We need to diversify to manage that, but we also need to think about every company's cash burn rate. So the longer that we are in lockdown, the economic activity is curtailed and has stopped, the more that cash burn becomes important because companies still have to pay their rent, they still have to pay their wages, and they still have other costs that they have to incur. And one of the key things is that there's a lot of debt out there. And over debt, those coupons, those interest payments, they have to be paid. And every day that goes by, there's an interest payment that needs to be made. And you can think about that as, as time goes by, there's this liability that's growing and growing and growing. But if the revenue's not there to service it, then you have a problem. And ultimately, this is why economies have to go back to work and we have to restart them. We can't afford to sit back and not restart economies because what will happen is this short-term crisis will transform into a solvency crisis. Because the longer we go on, the more that debt weight will crush more and more companies and will make them insolvent. So the reason why you're seeing politicians really try and get back to economy started again is because the longer this goes on, the more of a solvency problem we'll have. So managing that survival risk is key. I just want to talk through, this is that same chart, so that earnings power to the price of the markets. I just want to talk through how we responded as this crisis evolved. So we have quite a dynamic investment process. Ordinarily, we have an asset allocation meeting once a month. In the month of March, we had 2 out-of-cycle meetings throughout the month because things had changed so much as we were going through that month. We started off with this valuation measure at about 20. So a pretty elevated level. Market was very complacent, very relaxed about what was going on. Credit spreads were really, really tight, so there wasn't much value in bonds. But equities could, even though they were overvalued, as long as nothing bad happened, they could probably give you a reasonable outcome, and slightly better than fixed income. We were underweight equities at this point because we saw the valuations were stretched, and it made sense to be a little bit more defensive. But as prices started to come down, we reached this point and we started to say, well, actually, because prices retreated quite materially, is it right to be so underweight equities? So we started to tentatively add equity weight back into our portfolio. So we operate in a risk-controlled framework between certain boundaries. So we started moving from that underweight risk position towards a more neutral position, but not quite there yet. Of course, there was still a lot of uncertainty. Things were moving very quickly. Things were getting worse. Those number of cases were rising. And then we got to this point, and here we start to say, well, think about our framework. We've kind of got below that 15 level, which has been the marker where historically that's formed a good place to enter equities. It's formed kind of a base where you've had a recession and it's been, it's pretty much all priced in. So at this point, we took the decision that it didn't make sense to be underweight given that context. So we moved to a neutral position. We couldn't quite bring ourselves to go overweight because this was a very different recession than we've had before. And in fact, we hadn't actually had the recession yet. We just knew it was coming. But then things carried on getting worse. And this is where we got to the panic section. And this is where the VIX hit that 80 level. And we really got to the point of maximum despair. And I've kind of marked it on there. This measure got to 13.3, which is pretty close to as bad as it gets. So at this point, we became positive on risk. So we started to move to an overweight position on equity risk, reflecting the fact that actually there's a lot of bargains out there. And if you buy good companies at this point, they're going to survive, then your return prospects are quite attractive. And what we've seen since that point is really a rally in equities of about 20, 23%, maybe 25% after today, back to the level that you can see where we are now. So I think you've got to have, when you're thinking about investing, you need to have a plan. You need to understand, what will I do in different circumstances? And that's what we do. So our plan was to incrementally add to equity weight as prices became more attractive and fear increased in the market, but to do so in a way where we're adding to companies that minimize that survival risk, that had really strong chances of getting through to the other side so that we could take advantage of the long-term valuation prospects. Okay. I just want to touch on some of the other issues that are important to consider at this point, and then we can probably get to questions and answers if we've got some. Now, the response that we've seen from developed market economies has been pretty extreme. Okay, extreme in the sense of closing down economic activity, extreme in the sense of printing a boatload of money, and in the US's cases, depositing it straight into people's bank accounts, and also bringing that Fed funds rate down to zero. So interest rates have been slashed to zero. The cost of money in the US is now free. So if you want to borrow, it doesn't cost you anything. And if we look at the Fed's balance sheet, so for those of you that don't know, this is a metric which shows how much money is being created and infused into the system. So whenever the Federal Reserve buys an asset off somebody or credits someone's bank account, this line moves up. So this reflects the amount of money they've pushed into the system. They might have assets on the other side of that. So they might have government bonds, they might have some gold, but this represents the number of US dollars that they've pushed into the system. Now it's up to the banking system whether it amplifies that and whether it lends it out. But roughly speaking, this is money that's gone into the system. And you can see the effect of the last month has really dwarfed all of the QE programs that we've had previously. So QE1, you can see 2009 there. Then you can see sort of QE2, 3, and in that 2014 where the balance sheet just went up month after month. And in 2018 onwards, you can see the Fed tapering off, trying to withdraw that money. And then curiously, at the end of last year, we started to see a few problems in the repo market, which is an area of the banking system where banks interact with each other. So banks were starting to struggle to lend to each other. There were some funding stresses in the market, which was not to do with the coronavirus or that crisis. It was a separate issue which we were concerned about, and I guess this has sort of dwarfed that, but we've moved on to a different, more severe crisis. But here you can see now that trillions of dollars being really printed and pushed into the system. And then just the last thing here is the banking system. So this is the year-on-year change in the loans that the banking system makes. So a couple of points. First of all, this is normally a positive number. So it's quite rare that the banking system contracts and makes less loans. It does happen in severe recessions. You can see 2009, the banking system contracted. You can see 2003 and then 1991. So when the banking system is not lending, you get a contraction. You get a contraction in GDP. But recently, it's hit that 10% mark. So not only is the Fed putting money in, but it's also the banks are lending as well. And this reflects all of those companies getting their revolving credit facilities, agreements with the banks to lend the money. They're just taking everything they can. There's been a rush for cash, and that cash is being deposited in people's bank accounts. So there's been huge amounts of money created by the Federal Reserve printing money, the banks lending money, and the central government mailing checks to people and doing that side of it. So in the longer term, we're not quite sure what consequences this is going to have. And this is something we're going to have to grapple with once we get on the other side of the current corona crisis. But it's just something to be aware about there. So the plan, I guess it's ever evolving as things are. Our plan was, to be patient at the moment. So recognizing that for long-term investors, prices have come back. It's actually quite a good entry point. Obviously, the more markets go up, the less good entry point that becomes. But it's a good entry point for long-term investors here. And it's a good, equities are a good thing for people thinking about inflation risk, because that is definitely something that might manifest down the road, given the three charts I've just shown. Investing after significant market falls, it does reduce your future investment risk. That volatility that we talked about, volatility is not can be a good measure of risk in the short term. And it's a good measure of when markets get stressed and fall, how much money might you lose? And you can think of 3 times that volatility as a good guide for that. But high volatility in itself isn't necessarily a bad thing for future returns, as we showed in that graph. So, think about what level of market exposure is right for you, for your risk tolerance, and kind of stick to that. It is a risky backdrop still. We've got a lot of things to get through. It's the end of the beginning. We've had the crisis. We've had the crisis readjustment phase. Now we've got to have the solution phase. That involves figuring out how to live in a world where we have this disease out there. How can we get back to work? How can we restart economies? What companies will be around? Some companies won't survive. They might have run out of cash already. So we have to manage that survival risk. It remains a risky backdrop for individual companies, but not necessarily for the index, the asset class as a whole. And really, it's about being patient here. That we've had that sharp snapback. From here, you would expect a slower, more compounding effect of growth. Because just recent news today, Donald Trump's out there talking about reopening the economy. I'm sure he'll take credit for the 3% move in equity futures that we've seen in the US market and the UK. But actually, I think that move that we're seeing today in equities is because there's a company called Gilead, which is talking about an experimental drug that it's been trialing out with corona patients. And it seems to have improved the outcomes. So there seem to be less people dying on this treatment. And there also seem to be quicker recovery times. So after a week, people are getting out of the hospital, off the ventilators. And really, I don't know if this is the drug that's going to work. It's quite a small sample size, so we're jumping ahead of ourselves quite significantly. But finding a treatment, an effective treatment, you know, that's one of the best ways we can get back to work. That relieves the strain on the hospital system. It speeds up the recovery. It eases the fear that people would have of contracting the virus. It reduces the, you know, the risk of dying from contracting the virus. And effective treatment, if we can get that, you know, that is something that would solve this and let us all go back to work. So there's a lot of people keen to believe that Gilead has found something there, but obviously only time will tell if that is actually going to be a solution or not. So I think where I come from, we will find something that resolves this, whether it's a vaccine in a year and a half, or whether it's an effective treatment, you know, in 6 months or in a month. And even if we don't, I think we're going to have to restart economies anyway. We're going to have to take some risk, whether that's, you know, working in slightly different ways. But you know, we're going to have to reopen some of these bars and restaurants, because otherwise they will all become insolvent, and they won't be able to restart on the other side of it. So it's a tough choice for politicians. They either risk a second wave of infections, or they risk you know, a large number of insolvencies within their economies. So they're trying to manage that risk. But really, the cure for this is an effective treatment, and you know, that might be that might be around the corner quicker than we might think. So that's all I had in terms of slides there. Hopefully we've got some questions. I'll unshare my screen and we can get to some questions if we've got any, Mark.
Questions that have come through. Thanks very much for that, Phil. Can I just ask your view? I think you touched on it in the last couple of screens. There was talk in probably about 2 weeks ago, states the markets are moving quite quickly. There was talk of a V-type recovery, a V-shaped recovery. I think that has been tempered now to more of a U-shaped, longer kind of recovery. Do you want to expand on that slightly?
Yeah, I would definitely. I wouldn't be in the V-shaped recovery camp. I think we don't quite know the damage that's been done to various companies' balance sheets. Okay, now it's great that we've got these lending facilities that are going to allow companies to solve liquidity problems. Okay, so they can tap debt markets, they can borrow from banks, and that's great. So we need that, and that's part of the solution. But for companies where that survival risk has just gone on a little bit too much, their balance sheets now might be so strained that even if they get back to ordinary situation, they might not have the profit stream that would be able to pay down that debt. If you think of some companies operate with very thin margins, okay, and they might be quite capital intensive companies, and they just don't have that level of profitability in a normal market environment to pay down the amount of debt that they might have accrued on the balance sheet. And we don't know how big that problem is yet. So I think there are going to be a number of companies, like in any recession, that don't make it through to the other side. And by definition, that means it's not going to be a V-shaped recovery, or if it is, that the second up leg of the V is not going to be as large as the downside of the V, because some of those companies in the index won't be there, or won't have the same amount of earnings power. So I think, you know, expect a more modest recovery from here, but one that's, you know, compensated for by valuations. It'll take time to earn some of that money back.
Thanks, Phil. Phil, there's a couple of questions that are coming through. I'm going to read you the first one in no particular order. First one is, I'm just going to read it off the screen. Would it be prudent to say that with potential global recession on the horizon, that markets have much more downside to go than upside implied? I think you've touched on that, but perhaps just to recap in response.
Yeah, so when we were at the lows, that statement would be false. I would say, you know, and then we would have much more upside than downside. But of course, market prices move all the time, and you know, we've recovered, let's say, 25% from those lows. You know, the more prices go up, the more risk there is to future investment. As I say, we've got a period of pain that's coming, and there's going to be a lot of corporations coming out with bad news. So I think I wouldn't say that there's more downside than upside. I think for a long-term investor here, it's an okay entry point, but you're going to have a little bit of volatility. So it might go down, it might come back up again. So I wouldn't expect much in the short term of returns. I just expect kind of a random distribution with as much upside risk as downside risk. But in the longer term return, then you start to compound again.
Well, as I mentioned, we've got attendees from 6 or 7 different countries, and there's a theme that's coming through in some of the questions. I'll summarize them. What's your view on China? Could they come out stronger?
Yeah, I think so. China, we don't have too many investments in China. We do own a position in Tencent, which we think is a really well positioned company. Tech globally is just a good place to be. It's a bit of a unique beast. One thing that does worry me is they were increasingly putting a lot of debt on there in order to generate less and less GDP growth. So I think China was going through a transition from investment-led, heavy use of credit to more consumer spending. I don't know how much this will set back individuals in China, how much this has damaged their personal balance sheets, whether they can start to get that spending going again. But China's just got a lot of people. My preference is to take advantage of China by investing in companies that sell products that Chinese people want to buy, rather than investing in the highly commoditized companies that China has. A lot of those businesses in China, they have quite low margins. They're kind of vulnerable companies. We prefer resilient companies that have strong balance sheets and are able to weather whatever is thrown at them. Whereas I think the banking system in China is going to be stressed by what's happened there, because those insolvencies, I'm sure that the Chinese government will solve it by just pretending it's not a problem. And they've done this before. They've created a bad bank, and then over time that bad bank kind of works through the debt problems. But I don't think we fully understand the impact of what's happened there on the companies and also on the financial system. But they're already struggling to get GDP growth, given that you can't build like a 6th airport, right? You eventually, people have got to buy washing machines. That's where your growth has to come from.
So the lead-on question to that, thanks. The lead-on question to that was, would it be time to consider investing in China? I think you answered that, but perhaps you can just touch on that again.
Yeah, I'm not a Chinese specialist as such. As I say, we only really have Tencent. Jim, I'm just going to say I don't know the answer to that.
Phil, the next theme that's coming out is what do you foresee for emerging markets? Obviously, there's been a slight lag on the effect that the COVID-19 has had on emerging markets. What do you see for emerging markets going forward, and perhaps take it region by region and focus on say African emerging markets for the point to this answer. That's the nature of the questions that are coming through.
Yeah, I would say I'm quite worried about the effect it might have on emerging markets for a number of reasons. Really 3 reasons, I guess. The first is, I don't think the hospital system in this has strained the hospital system in developed market economies. And we spend a ton of money on the NHS, on healthcare in the US, in Europe, and yet it's strained our hospital system. These ventilators that everyone has been scrambling for, there's only so many in the world, and I would imagine that the richer countries have basically stolen them and hoarded them. So access to equipment and the medical system in emerging markets would be a worry. How can they cope with that? Then part of the solution that we've had has been to print a ton of money. And, the US can do that because it's the US, it's the reserve currency. If other countries try and print a load of money and have the same solution, you might find that their currencies come under a lot of pressure. So I don't necessarily think that avenue is there for them, which means that emerging market economies are just less able to find that solution out, which is a worry. And then I guess the third thing, let's say that there is a treatment that is made available, how much of that can be produced and who would get it first and what would it be priced at. Um, I'd like to think that the world would share that equally and everyone would get a chance at it. But if it's a drug that's produced, there's only so much you can ramp up. You've got to have a factory that produces it, and you've got to make sure that you produce it to the right level of quality, etc. And then that corporation is going to want to make a profit out of it. So I don't know the dynamics of that side. So those three things worry me: that the hospital system, can it cope? The currency strength if you try and do fiscal and monetary stimulus, and how affordable will the treatment be? And I think emerging markets are just less well placed to cope with that.
The question that has come through, thanks, Phil. Another question: for clients that are wanting to get into equities, what would be your advice?
I think about your long term, how much risk you can take. Okay, find yourself an anchor, and then from there you can start to think about, okay, should I be taking a little bit more at the moment or a little bit less? And that depends how tactical you want to be. We are tactical within our skill level. So what I mean by that is, whenever you make an investment decision, you never know for certain how it's going to pan out. Okay, you're always making a decision with a backdrop of uncertainty, and prices could go up or they could go down, but you think you've got an edge. In order for that edge to come through, in order for those decisions to manifest in good outcomes, you need to be able to make enough of them in order for the randomness of markets to kind of wash out and for the skill to come through. So when you're talking about, is it a good time to buy equities or not? That's a very binary decision. That you're either in equities or you're not in equities, and you can't diversify that with any other decisions. So even if you're a really, really skilled investment manager and you're right 55% of the time, you're 45% of the time wrong. So when you start talking about that one decision, you've got to balance that with your level of skill. So I would say, first put a marker in the sand and say, how much equity weight am I comfortable with? Do I want to have for the long term? And then play around that in a controlled range that's in line with the level of skill that you think you've got. I think it makes sense at the moment, given where prices have come, to basically be at that long-term goal that you've got. So don't be overweight risk assets at the moment. There's, compared to that long-term goal, there's still a lot of things that we've got to work through. But equally, don't be underweight, because it's not necessarily the case that markets might fall materially from here. They might have some sort of correction as companies come out with bad news, but equally the market might just look through that if we've got a treatment, if we've got a path to coping with everything. So I think keep a little bit of dry powder in case you get that chance to buy lower, but don't assume you're going to get a chance to buy lower, because you might not. And actually, given all the money printing that's gone on, things might just drift up, anyway.
Thanks, Phil. I'm cognizant that we're running out of time, so the questions are coming through thick and fast. But I think I'm going to ask two more questions. The one is more or less a run-on to what you've mentioned. Quite a broad question. I guess we could go on for another hour, but just keep it brief, peaceful.
Okay.
For investors' portfolios, what actions should they take?
So I missed the end bit of that. What action should they take in their portfolios? Or okay, I think you want to have a look at all the positions you've got and make sure that you're comfortable with that survival risk. So make sure the companies you're invested in, or the managers that you've got working for you, are thinking about, can this company get through it? I don't think it's sensible to take too much risk in highly leveraged companies that are very, very cyclical. Don't put risk on in that way. Put risk on, put more weight into good companies that are likely to get through that. I think that's the most sensible way to approach it. As for, other things, I think, think about that concept of inflation might be a problem down the road. So think about companies that have a bit of pricing power, companies that have, a competitive advantage. If you're just in a company that does what everybody else is doing, then they don't really have any pricing power, so they might struggle to keep up with inflation. So I think have that inflationary, and if you can buy income streams that are linked to inflation, I think that's a good thing as well. So those two things: make sure it's a solid company, and think about that inflation risk. Some things with pricing power.
Thanks, Phil. Just a note to our attendees, I'm not going to be able to get to all the questions. You're welcome to email me. You would have either myself or Amri or Anne, and then we'll flick those questions onto Phil. So apologies, so I'm not going to get to everyone's question. Last question, Phil. Government bond yields are at multi-year lows, and corporates could be facing huge debt burdens as the coming months unfold. What are your views on bond funds in this current environment? I think you did speak to that, but if you could just recap.
I think corporate bond funds, so high yield bond funds and investment grade bond funds, they compensate you for the risk of credit. So I think they're okay. You're going to get a return there that's acceptable. There is, as I was saying, this growing risk of inflation though. And if you think of where government bond yields are, they are very, very low. Even in the US now, and I think the last time I looked at the 10-year was 50 basis points or just under 50 basis points, so 0.5% for 10 years to lend to the US government. So there's no doubt that in the long term, if you hold that bond to maturity, your purchasing power is going to be eroded. You're going to get your 0.5% yield to maturity, but it's not going to compensate you for what inflation is. We invest in government bonds because they're still very effective risk control vehicles. So when equity markets and credit falls, those government bonds hold up well. They're very liquid. You can sell them. So they do nice things for your portfolio. And in a sense, they allow you to take more equity risk by that diversification benefit. But they're not a great long-term investment return vehicle. And you've got to balance that off, really. Where we do invest in government bonds, we've taken the view that we want the inflation-linked bonds. So we hold inflation-linked bonds as our preference to try and protect us from that inflation. But it's also fair to say that we've increasingly been taking weight out of government bonds, and we hold a small position in gold now to compensate instead.
Okay, thanks very much. Phil, it's been an absolute pleasure. Thank you very much for agreeing. From the number of questions and so on that are coming through, I think you're going to get quite a few. We might arrange another session. So to all our attendees, thank you very much. And if you have any questions, feel free to email myself, Anne, or Amri. You would have had our details in your invitation. So Phil, thank you very much. Appreciate your time. And let's hope the recovery, the U-shaped recovery, starts sooner rather than later.
Perfect. Thanks for having me, Mark.
All right. Cheers, everyone.